Hey, this is Andrew Kuhn, and you're listening to the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, timeless investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along. Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, sitting next to Mr. Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How is it going with you?
It's going well. We hope it's going great for everybody else as well. Hey, if this is the first time that you are checking us out, go to YouTube and hit the subscribe button. Also, check out all of our other work. We blog about ideas at focuscompounding.com. We talk about ideas, obviously, on the podcast or the Podbean app. Over 145 different episodes. Having a lot of fun doing it. And then, of course, we tweet out a ton of content at Focused Compound on Twitter. Also, if you want to join our free email list, go to focuscompounding.com on the homepage and enter in your email to get a free weekly idea from Focused Compounding. So today's podcast, we're going to be actually going over our snap judgments on 5 different stocks. Again, just want to preface it. This truly is a snap judgment. We don't want to upset anybody. If you know the story more than us, you probably should, because we're literally looking at the stock from QuickFS, really from a bird's eye perspective. But actually, it's good to do this because a lot of people, they reach out to us and they're like, hey, this is the story on the stock. And we love when they do that. So if you want to do that, email it to me at Andrew@focuscompounding.com. And then I will make sure Geoff sees that. And the first stock we're going to be going over is a company that Geoff and I both took a look at, and that's Graphtec. Graphtec International, ticker EAF. It is a $3.6 billion market cap, currently trading at a PE of 4.5 times, which you could explain what that means here in a second. 10-year revenue CAGR is 4.8%, going from $659 million in 2009 to $1.8 billion in 2018. 10-year median gross margins of 20%. 10-year median EBIT margins 9.2%, and then EV to sales is 2.7. So, of course, we would like to see them have EBIT margins of somewhere in the neighborhood of 27%, and that's just not there. Obviously, you looked at this company, 10-year CAGR of free cash flow is right around 16%. It's trading at EV to free cash flow of about 7 times. Very cyclical company. If you look at the return on invested capital, it looks like it's been all over the place. Again, we are using QuickFS. That is quickfsfinancialstatements.net. Be sure to take a look at it. No affiliation to us. But they did add a business description, which we do like.
Oh, this is going to be a rough business description, but go ahead.
Yeah. Graphtec International researches, develops, manufactures, and sells graphite and carbon-based products worldwide. What the heck does that mean?
Using the QuickFS,
we spent some time talking about this company because we read the Graham and Doddsville report where Monish Pabrai was talking about this company. It's a very Monish Pabrai type of situation as well. The heads I make money, tails I don't lose too much.
Right. Also written up on the website.
Not
by me.
No.
Not by me. The things that we'd see right away are you gave like a CAGR number for revenue and stuff like that. That's meaningless because it would be a negative number for the 10 years previous to this most recent year, right? So what was it in 2009 revenue?
$659 million.
And what was it in 2017?
$551 million.
So it was down,
yes.
And then it's up. All the growth
to
is
1.8
in 1 year. It's up 250% revenue. In
244. Yep.
Right. We can see return on invested capital just from the graph that the return on invested capital was negative in a bunch of years and persistently negative for a really long period of time twice. So those are some very deep declines in the industry or whatever they're doing. But then it also had these long periods of up period, which was in the mid 2000, first decade of the 2000s, I guess. What is that? Starting in 2003 or so for about 5 or 6 years. So they had good returns. And now they have returns that are higher on a return on capital basis and a lot of other things than anything they've had that we can see in the past. Seems like very long cycle, right? So just looking at the graph, it seems like you have like 5 bad years and you have 5 good years. You have 5 bad years, that kind of thing. Very, very long cycle. It just immediately looks like something that I want to be interested in. And especially because it has incredibly high results now, which is the time when I would not be interested in a company like that. I'd be interested in the time when it's reporting bad results. However, we did read the article, and
that was posted on focuscompound.com.
Yes, and we read the Graham and Doddsville thing, which is where it's mentioned by Pabrai, and he makes a case for it, and it's based on contracts that they have in place for the next few years, which basically guarantee that they're going to make a certain amount of money, or they're going to make a lot of money for the next few years. And from reading that, I believe that's true. But I don't necessarily know if that means the stock will ever go up that much.
Yeah.
Because the problem is, if the market looks at it the way that I would look at it or something, they might say, well, this deserves a PE of like 2 or 3 or 4 for the next few years, because you have no idea at the end of that. Like, for instance, look at the enterprise value to the market cap, right? So you have the
the market cap, $3.6 billion.
Okay, so let's just look at PE, for instance. What's the PE?
4.5.
And what's the EV to EBIT?
EV to EBIT is 5 times.
Right. So somehow they have a higher EV to EBIT than they do price to earnings, which means their enterprise value is quite a lot higher than their market cap. So unless they pay off their debt, they're going to have debt at the end of this period too, and they're going to have to sell some sort of revenue or something that after these contracts come off in the next few years. So they have guaranteed contracts looking out, 3, 4, 5 years, which is what this whole case is based on. And that might be justified, but then I just don't know how much the business is worth after that. That's the problem. And so I have nothing against the argument that people make for the next few years in this stock at all. I just don't know what the terminal value, if you want to call it that, is after that period. Mm-hmm. Now, the microeconomics of it were interesting. I thought it was going to be a complete pass right away. And then when I read about some things about why it might be difficult to have not difficult, but why additional supply might not be coming on immediately. This is a commodity business. They made sense to me. So basically, part of what's happening here is that there's a byproduct of that is unlikely to be increased dramatically. Simply, you're not likely to produce a lot more of it, simply because it's a small part of the output of the total thing that you're breaking down. So that was interesting to me. That was the one part of the story that surprised me and that really interested me. The other part about how long it takes to add a totally new plant worried me. I know that other people who are looking at it on a short-term basis love that, like, oh, it would take 5 years for this to happen. But you have to understand, if you're in an industry where you have like bonanza profits right now, and it takes 5 years to build a new plant capable of doing what they're doing, there is a risk that everyone will try to build a new plant, and that means that in 5 years, everyone will be losing money. And I'd be really worried about that. Mm-hmm. So
couldn't you make the case, though, that people would know that? It's kind of like the cement plant. People that have a cement plant aren't going to put another cement plant like within close proximity, because then they're all going to be losing money.
It's possible. Yeah, I don't disagree with that. But that also comes into you mean the players in the industry will know that and not do it. Mm-hmm. Yeah, they could. They could be that rational. On the other hand, you could say the same thing about investors.
Sure.
There's a reason why investors are putting a 5 PE on it. Are they right or wrong? I don't know. I have no idea what the value of the company should be after the next few years of what their free cash flow will be. And I think all the arguments for it are that it'll have a ton of free cash flow in the next few years, which is fine. I also don't know if they'll pay it all out to shareholders or buy something totally different or something. I see no evidence that that's what they plan to do, which means that it's going to go back in the same business. It's not a business I want to be in. So I think that for me, it's just a pass. It's very complicated and not an industry that I really want to be in.
Sure. Next company, Sinclair Broadcast Group, ticker SBGI. Market cap $2.8 billion. Currently trading 14 times earnings, 25 times EV to free cash flow. 10-year median margins on gross profit, 63%. 10-year median margins on EBIT, 23%. We have a 10-year CAGR of 15%, going from $656 million in 2009 to $3 billion in 2018. Return on equity looks, good, I guess, after 2013. It looks like it's been higher, and the 10-year median returns on that is 42%. Let's see what they do. Sinclair Broadcast Group, Inc. operates as a television broadcasting company in the United States. It owns or provides various programming, operating, sales, and other non-programming operating services to television stations. Thoughts? Return on invested capital looks jumpy. Kind of all over the place.
I assume that's like write-downs or something. That doesn't make sense on a cash basis. So I guess my issues would be...
Can I cut you off really quick? As of December 31st, December 31st, 2018, it owned, operated, and provided services to 191 stations in 89 markets, which broadcasts 605 channels.
Yeah, I think people know this stock. I mean, they know the company.
Yeah.
What's the price to sales ratio?
Price to sales is 0.8.
And what's the EV to sales?
EV to sales is 4.0.
I don't want to pay 4 times sales for a local TV station owner. So I just don't know enough about the future. So I just don't want to pay that much. On a leverage basis, it might work out great. But I just don't want to do that.
Yeah. Got it. Alrighty. Next company.
It's because of the durability. It's because if it was 1980, I'd be fine doing it. But yeah, not in 2019, no.
Mm-hmm. It was interesting. We were talking about, I guess, streaming in general the other day. And we were talking about, because I watched The Irishman, the 3.5 hour long movie. I literally fell asleep during the movie and woke up and it was still going on.
Nielsen says most people did that.
I swear I did that. And it was a good movie. It was. I did tell Geoff that, so for spoiler alert for people that haven't seen the movie, Robert De Niro plays this American this gangster, if you will, and at an early part in his life, he was playing probably like a late 20s, early 30-year-old, maybe a little bit older than that. And at one scene, he was beating some guy up. And I was like, ugh, De Niro. Like, you could just tell that he was,
right.
It wasn't Robert De Niro in Goodfellas, is what I'm trying to say.
Yeah.
Anyways, great movie. But we were talking about how Netflix, they purchased the rights to Irishman for, how much did it say? It was like 120 million, 150 million. We just
the reports were that, but I don't know what they're counting it and stuff. But yeah, that's industry reports, yeah.
But it was just interesting. Like, we have all the streaming wars going on, but you could probably make the case for studios, how it's probably... all this streaming wars, it's probably a better situation
to make the content.
Because now you're going to have all these bidding wars going on for all this content, and because everyone's going to want it on their own platform. I mean, so
but there are very few that make the content without also owning the stuff that distributes it. Like DreamWorks Animation, we talked about, was a public company. They made it and didn't have a distributor. They had to sign deals with other companies like Fox and Universal and stuff to distribute for them. So they were in that position, and they would sell to HBO and to Netflix. They had output agreements with each of those. Eventually, Netflix was willing to bid more than HBO had been. But mostly the problem is like Disney or something, right? They have all this great content, but then they also own all this stuff that, like ABC and stuff, they own ESPN, they own all this stuff that also is mostly just distributing a lot of content and has to pay for a lot of rights to all that stuff,
Yeah, I thought it was interesting. Anyways, go see the movie. Next company, Thor Industries, ticker THO. Definitely not an overlooked stock, but somebody did request it from us. Market cap $3.8 billion, EV to free cash flow 14 times. 10-year median margins on gross profit 13%. 10-year median margins on EBIT 7%. 10-year CAGR is 17%. Well, actually 18 if you want to round up. 2010 going from 2.2 billion to 7.8 billion in 2019.
Right, because our period that we're looking at here is starting in 2010.
And they design, manufacture, and sell RVs.
Right, how many
and
RVs
related parts
in 2010 or right before then? Probably not a lot.
Yeah, sure. Thoughts on the company? Is this a business that you would own?
I believe it's very
10-year CAGR and free cash flow 24%. 10-year CAGR and EPS 23%.
That doesn't matter.
Yeah,
because it's coming out of a huge recession.
Sure.
I mean, in terms of the price, what's EV to sales?
0.7.
Okay, and what is the operating margin?
10-year median margin for EBIT 7%.
Yeah, but more than that, just like start in 2010 and read me the EBIT, the operating margin for each year.
Okay, 2010, 7%, 5%, 6%, 7%, 7%, 7%, 8%, 8%, 8%, 3%.
Yeah, so that looks great. I mean,
very predictable, right?
Yeah, and taxes have been cut now, so that compared to what they were at the beginning of that period, so they're paying a lower tax rate, presumably on that. You adjust for that fact, and that's like what, around 10 times, normalized. Their sales right now normalized for the margin is like 10 times pre-tax profits or something, which with the tax rate that we have now is a low double-digit PE type ratio, or adjusted for leverage. What I'm saying is adjusting that for leverage because we use the EV. Now sales could be unusually high. I don't know that they aren't, but I don't think so because a couple of years they're at the same level now as they were a couple of years ago. But they are really high compared to what they've been over the average on the entire cycle, and so that's a potential problem. I don't know where we are in the cycle. The people who follow this industry may know that we have like unusually high sales, and we have for the last few years or something, which could be the case. If it's not the case, and this is a normal sales level, then it looks attractive. Return on invested capital and stuff is fine over the full cycle that we've seen. We didn't see, this doesn't count the very bad period of before 2010. I don't think we don't have any information on that, do we? We have return on capital information in the graph.
Mm-hmm.
So, yeah. Interesting. It might be a good time to buy it if people start thinking that you're in a bad time in the cycle. I've said that before about a business like this. So if it generally has high returns on capital and you can pay a price that is very reasonable on like an EV to sales basis using the past operating margin over 10 years or more, you have to use a very long operating margin average, then yeah, I'd be interested. But the problem is the last 10 years, I'm worried that we haven't seen enough of what would really happen in a cycle. Those numbers seem very, very stable for what should be such a cyclical company. So that'd be something to look for. But yeah, compared to other things we've talked about so far, this looks good.
Interesting. Alrighty. Next company, Inseego Corp, ticker INSG, market cap $591 million. Let's see. What do? They design and develop of mobile Internet of Things and cloud solutions for large enterprise verticals, service providers, and small and medium-sized businesses worldwide. The company provides wireless 3G, 4G, and 5G hardware products that address various markets, including fleet and commercial telematics, aftermarket telematics, smart city infrastructure management, remote monitoring and control, blah, blah, blah. Okay. Valuations, we can look at the PE looks pretty messy, so we'll use EV to sales. EV to sales is 2.6. 10-year median margins on EBIT is negative 9.4. Definitely not something that we'd probably be interested in. And then even when you look at the revenue from 2009, it's gone from $337 million to 2018, 202 million. So a negative 4.5% 10-year CAGR. Thoughts?
I don't know. Based on the data that we have here, I don't know. I don't know if there's a problem with the data or something. Telematics is somewhat interesting, and I'd be interested in that industry.
Yep.
The EV to sales doesn't seem super high for a telematics company. EV to EBITDA seems maybe a little high. What is it? It says 20. So, it's kind of an expensive thing for us, but I just think either something's wrong with the data or it's not that attractive because I don't really understand that. What does the last sentence say? It says something about Sprint?
The company has a strategic partnership with Sprint Corporation to deliver IoT solutions for aviation, transportation, logistics, and manufacturing industry verticals.
And it's a U.S. company. I don't know. This is just one that I just don't, based on the data I'm seeing, I can't make any judgment. The data doesn't seem to match up with the price of the stock.
Got it. Last company we are going to be going over, Sinclair Aviation Services, ticker SKAS, market cap of $7 million. So here you are. If you're looking for a company potential in your PA, $7 million market cap.
It's not a snap judgment for me. I've seen this stock before.
Jeff has seen this stock before. PE of 12 times, EBIT to free cash flow of 6, 10-year median margins of EBIT 8%, 10-year gross profit margins 46%, 10-year CAGR on revenue 2.6%, going from $9 million in 2009 to $11 million in 2018. 10-year median returns on return on equity 9%. Let's see. Through its subsidiaries, operates in the aviation services segment of the general aviation industry in the United States. The company serves as an operator of a heliport, a fixed base operation, FBO, a provider of aircraft maintenance and repair services, MRO, and a consultant for seaplane base. It also provides ground-based services such as fueling and aircraft storage for general aviation, commercial, and military aircraft, as well as other miscellaneous services.
It
is carried out as the operator of the downtown Manhattan
That's
heliport.
The part I remember.
Yes.
Mm-hmm.
And Kansas too, Garden City Regional Airport. Ever been there?
No, I've never been there.
All right, thoughts?
So my thoughts about this are: I know I've read their reports and stuff. And
when you're doing research on Breeze Eastern?
No, literally because of looking at this company, thinking it looked attractive because of this description of what it does.
Yeah.
So I was very interested based on what it does. I passed on it because of stuff that I found in the report, and I don't know what that is, and it's not described here. So it's possible that I was concerned about like if a contract would run out or something like that. I don't know why else I would be concerned. It has had revenue decline over time and stuff, which may not be because it was at one site that happened. It could be that they lost a contract or something. If it's relying on just a couple locations, and if I remember, I don't remember anything about Kansas. I just remember Manhattan. Then that would have been my concern, and so I have no way to judge the durability of it. Obviously, on like enterprise value to free cash flow, EBITDA, sales, price to earnings, even okay. I mean, leave out price to earnings and price to book, but all the cash flow versus enterprise value stuff looks really, really good. It's just I can't know without knowing the durability. So if someone told me, oh, they have a 99-year lease on that or whatever, I'd say, oh, then this is an attractive stock. If they said it's going to run out next year, then it's not an attractive stock, and the truth is probably somewhere in between those two.
Sure. Cool. Any other thoughts on that company?
No.
When did you look at it? Do you remember?
A couple of years ago.
Got it. Which company that we looked at today would you be most interested in learning a little bit more about?
For us personally, not Thor. It would have to be Saker or whatever that company's called.
Yeah.
What's the ticker on that one, by the way? Just so
Saker?
Yeah.
SKAS, trades over the counter.
Yeah. For us, that would have to be it because we focus on overlooked things and stuff. For people listening to this generally, I'd say Thor.
Got it. Thor. So there you go. If you want to send us a stock in the future, you could either DM it to me at Focus Compound or email me, Andrew at focusedcompounding.com. I want to thank everybody so much for tuning in with Geoff myself. Hit the subscribe button, thumbs this video up, leave us a rating review, check out all of our other content. Go to focusedcompounding.com, enter in your email, and join our premium website. That is focusedcompounding.com. I want to thank everybody so much for tuning in with us. We will see you in the next podcast. Take care. Hey, this is Andrew Kuhn, and that was the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along.